Okay, so I think what I'd like to do here is take a bit of a step back to a chapter that we looked at in the previous class, although I think that we did not actually write any code for this. So I would like to get started by reviewing the binomial option pricing model because it's a very important model. This is the first time, as you recall, from the summer rather, that it became possible to price American options. You might remember that the Black-Scholes model was designed only to price European options. So, and of course, that paper was written in 1973, and at the time, they didn't really fully appreciate how important their model proved to be. But soon enough, it became clear that it would be good to have another model where we could price American options because, as it turns out, most options in the marketplace are European. I'm sorry, they're American. So that's why it became so important. So anyway, about 3 years later, a paper came out by three researchers named Cox, Ross, and Rubenstein. And the intention of the paper was really more than anything else to explain in a slightly different way what the Black-Scholes model is really doing. What they basically did was they took the Black-Scholes model and they broke it up into a series of discrete time steps so we could analyze exactly what was happening at each point in time until at the very end we would obtain the option price. And they set it up to make sure that the binomial option pricing model has the exact same assumptions as Black-Scholes so that either model should give us the same price for a European option. But it brought along this binomial option pricing model, also brought along this amazing benefit that it suddenly became possible to price American style options as well, because unlike the Black-Scholes model, you can stop this model at discrete steps in time and analyze and decide should we exercise the option or not. Okay, that's really what's missing from the Black-Scholes model. It's basically the way the model works is it takes the data from today's time and it projects out to the maturity date of the option using a stochastic process that only shows us what happens not in between, but shows us where we are today and shows us where we'll be when the option matures. So in other words, it's not possible to determine what might happen in between. And so we can't go through and find out if there's any points in time where exercising the option early might actually make sense. So here, this is different now. All of a sudden, we do have that ability because of the way this model is structured. So we will review this as we go along. But you might recall that what's essentially happening is you're taking a continuous process and breaking it down into a discrete process based on the binomial probability distribution from statistics. And the reason why this works well is because, as you recall from statistics, the binomial um, distribution in the limit converges to the normal distribution. And so it enables us to retain the assumptions of the Black-Scholes model and yet still be able to price American options. Now, since this first paper was produced or published, there have been many other variations of this model that have been published in the literature with different assumptions, different ways of implementing the model. What usually ends up happening with these models is the easier it is to implement it, the more unrealistic the assumptions are. So for certain situations, this model may not be the best choice. For example, with interest rate options, there are more complexities that we need to take into account. And by the way, that's one of the reasons why the trinomial option pricing model was created. But for just straight ahead, simple, plain vanilla European call options on stocks, like the Black-Scholes model was originally based on, this binomial option pricing model does an excellent job. In fact, if we have enough time steps in the model, we can show that the results must converge to the Black-Scholes price. Okay. Anyway, so how is this thing implemented? That's what we really want to know. Now, this time we're going to go through it again, but what we're going to do is also introduce the VBA code that we need to implement it properly. And we'll see that we can set it up in an Excel spreadsheet. And that way we can follow along and watch how the stock price evolves over time. And we can also see how the option evolves over time as well. Anyway, so that's where we're going right now. And then when this is done, we've got a lot more exciting topics to cover. We'll be able to go to things that we didn't do in the summer. For example, let me just take a look at the list um, of topics we've got. Oh yeah, there it is, the trinomial trees that I just mentioned, which really are trying to price American and European options, but in a somewhat more complex way. And then we have something which is actually quite different, which is called Monte Carlo simulation. And that is where we are not really using a lot of market data. Instead, we are using the assumptions underlying the asset that we're pricing and using that to simulate prices, which you might not think would be such a great idea. But for certain types of options, this is the best approach. Certain types of options that don't trade very often, where we can make fairly realistic assumptions about the behavior, they lend themselves nicely to Monte Carlo simulation. And then we have finite difference methods, which are sort of an extension of what we did with the trinomial trees. And then we have a separate chapter just for interest rate derivatives because they're very complicated, but they're awfully important. And then that'll give us an excuse to take a step back and look at how interest rates are modeled in the economy. And then we'll see. We'll then eventually at some point we'll take a look at stochastic processes because all of these derivatives models are ultimately based on stochastic processes. Okay. Anyway, so we'll get to that as we go. But right now, we want to focus our attention on the binomial option pricing model. So let's just remind ourselves how this is set up. Let's see. Let me just jump ahead and look at the graph with you. Here we go. So for a very simple one-period model, you might recall that we're assuming that the stock that we're pricing with our option starts here today with the value S, whatever that happens to be. And then in one period, it can only do one of two things. It can go up or it can go down. Okay, so T equals 1 could be next year, but it doesn't have to be. It could be next week, next month. It doesn't make any difference. But whatever it is, we designate that delta T, which is thought of as a fraction of a year. So if this is a model that shows what happens in 3 months, delta T would be 0.25, which is a quarter of a year. Now, if you notice when it goes up by a multiple of itself, U times S. U is a constant. So in other words, SU means S times U. So whatever S was initially, we now move up to S times U. And then D is also a constant. Important thing here, at least in the Cox-Russell-Rubinstein framework, is that they're inverses of each other. So that U times D equals 1. All right. Now, the reason why that matters is because it means that if the stock goes up and then down, it'll reach its original level. And the same thing is true if the stock goes down and then up. Okay, so it's kind of like moving along a chessboard. I guess you could think of it that way. Up, down is the same thing as down, up. And again, this is one of the areas where this assumption is not absolutely necessary. Later researchers produce models where this is not necessarily true. And it's just that, with Cox-Russell-Rubinstein wrote this paper, they were trying to make it as apparent as possible what they were doing. So they may have made some assumptions that weren't perfectly realistic, but the model still works very well. Okay. So also another point I just want to mention here as we're going along, this assumption also reduces the computational time needed to implement this model because if going up and then down didn't bring us back to the same point as down and then up, the tree would be much, much larger, quite a bit larger, as a matter of fact. So this is not only a good assumption in the sense that it helps us understand what's happening, but it also speeds things up a bit. Now, keep in mind, these models were developed in the 70s. As you can imagine, the computing power available to them was pretty primitive compared to what we have now. In fact, probably even if they're working at the biggest universities, which Black and Scholl certainly were. I believe Fisher Black was at MIT. If I remember correctly, Merton was at Harvard and Scholes was at Stanford. And Cox, Russ, and Rubinstein, I think they were at Harvard. So even those big name schools, the biggest computers that they had available to them were probably less powerful than an Apple Watch today. So you can see the stress here is on efficiency. They're trying to make sure this framework is not only accurate, but that it's as quick as possible because the computers of the day were just terribly, terribly slow. And they also didn't always work. They would just sometimes just run and then they would crash and then you'd have to start all over again. It was just a different time. Okay. Um, we're kind of spoiled now with the computer power that we have available to us. It wasn't like that in the 70s. In fact, just to show you, even handheld calculators only started being introduced in the early 70s. So that shows you how long ago this really was in terms of technology. Anyway, now the option itself, we're going to designate that with the letter F. We could use C for call or P for put, but then P starts getting confused with probability. So we're just going to stick with F. This is how John Hull, this is what he does in his book. Remember, this course is based on John Hull's textbook, Options, Futures, and Other Derivatives. And this is his idea. And I think it's a good idea to have F because then it can stand for either a call or a put. And so this is the tree for the option that is being priced based on this stock price. And you can see it also starts at 0. And then one time step, it moves up to whatever values we have. This is still delta t. And except now what's different here, though, is that when F goes up to FU, this FU is a subscript. It's not a constant. Oops. D is also a subscript, as you can imagine. So in other words, what this is meant to show us is that F sub U just means the value of the option when the stock price goes up to SU. Okay. In other words, if these were side by side, you could see it more easily that this is the option price that you would get if the stock price reaches SU. Okay. And the corresponding value for the downstate is FD. Okay. So again, we don't know what that is, but we do know it is the appropriate value when the stock has reached SD. All right. Now, I just want to mention that in general, when we start pricing these options, the value of the option equals what we call its intrinsic value or payoff. Okay, now let's recall it real fast. The call option payoff is the maximum of S minus X and 0. Where S is the stock price, X is the strike price. Of course, max means maximum. So basically what this is saying is that if the stock price is greater than X, then we'll have a positive payoff equal to the difference between the two. Okay, so in other words, if S is greater than X, the call provides positive payoff equal to S minus X, which of course is greater than 0. Otherwise, the payoff is 0. Now, the reason for that is because, and this is the key detail, this is what makes options so much better than some of the other derivatives out there, like forwards. This is because the option owner is not required to exercise the option. When S is less than or equal to X, the owner will not exercise the option. Because if he did, he would have a negative payoff. So we're assuming that nobody would actually do that. That everybody will say, whoops, why would I exercise this option at this point? I'll just walk away from the whole thing and I'll have the payoff of 0. Okay. So then, of course, with the put, remember now, the put is the one that gives the right to sell. The call, just quickly remind you, is the one that gives you the right to buy an asset. Let's see, where can I sneak that in? Just a quick reminder, yeah, the call is the one that lets you buy the asset at strike price X. The put is the one that lets you sell it. So the call is the one you buy if you think the stock price will go up, and the put is the one you'll buy if the stock price goes down. Okay, and then for the put, the payoff is therefore a little bit different. The max of X minus S is zero. Okay, so it's simply the reverse. The X and the S have been reversed, but still you can't have a negative payoff with a put either. So if this means that if S is greater than or equal to X, the option will not be exercised. If S is strictly less than X, the option will be exercised and provide a payoff of X minus S, which by assumption is positive. Right? So those are the two basic, what we call plain vanilla options. There, we'll see later on when we're dealing with Monte Carlo simulation that there's quite a few other very complex ones that are collectively known as exotic options. Okay, I think you'll find that very interesting. It starts to make you wonder, like, who thought of these ideas? Now, the interesting thing about options, they're the only derivatives that trade in the on exchanges like the Chicago Mercantile Exchange, but they also are available in the over-the-counter market. That's not normally the case. Most assets are either one or the other. For example, if you recall from our last class, forward contracts are traded in the over-the-counter market. They're negotiated directly between counterparties, but the advantage of that is that they can be customized to the needs of the buyer and the seller too, for that matter. The futures contracts are traded through organized exchanges, which means it can't be customized in any meaningful way. They're whatever is available is what you have to buy or sell to the Chicago Mercantile Exchange. So options, because they're available in both forms, um, if I need an option, for example, that's very strange, but unique to my circumstances, I can go to the over-the-counter market, which means I can find an investment bank who will put one together for me. In fact, if you go to these investment banks, they'll have teams of people that work on derivative securities all day long. And among many other things, what they might be doing is when a customer calls up and says, listen, I need this option that does this, this, and that, their job is to figure out what the price should be before they sell it to the customer. And interestingly enough, I know somebody who told me that these teams, you figure they've got mathematicians, they've got financial engineers, they've got economists, whatever, but they also have a lot of lawyers because ultimately these products are contracts. So the lawyers have to design an airtight contract to make sure that the investment bank doesn't get burned if something goes wrong. Okay. It's legal. These guys who specialize in securities laws, they're in big demand and they get paid very, 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 very well. Okay. So anyway, back to this. Um, so we have the different payoffs to the two types of options. And just as a quick review as well, remember the profits are a little bit different. With the profits, we have to take into account the cost of an option because when you're the buyer, you have to pay for it. So the call profit or loss is the payoff minus the call price, and the put profit or loss is the put payoff minus the put price. Okay. So that means you can have a loss, but it's capped at the price of the option that you paid for it. Okay, so in other words, you can't have a worse outcome than losing the money that you paid for your option. Not so with some of the other derivatives. You can lose all kinds of money if something goes terribly wrong. So anyway, so back to the diagrams. This is the stock price, and this is how we'll model it. And you notice it's always up and down by the same amount, by the way. Um, and this is the corresponding option tree. So what brought up all this discussion about payoffs is that when we get to the end here, if this is the maturity date of the option, then we know how to calculate this. This is going to be the payoff of the option at the maturity date. Okay. So that's why we have this discussion about payoffs, just to remind ourselves what payoffs are equal to. So at the maturity date, if this is a one period model, that means FU and FD are simply the payoffs to the options based on the stock prices SU and SD. It's the, and by the way, I just want to remind you too that with a branch structure like this, um, we have something, a diagram like this one, which I'm going to try to draw properly. So the terminology here is that every point at which we'll have a new value for our option or our stock is called a node. And then the path that we follow to get there, these are called branches. Now, this entire structure is often called a tree, or sometimes it's called a lattice. Okay. So again, we have ups and downs because it's a binomial model. The size of the up and down movement is always the same. So in other words, if you had a two-period model here, let's draw another one for, let's say the stock goes from here to here. By the way, I want to point out that in the slide, sometimes it says SU, sometimes it's US. It doesn't matter, obviously, because it's a product. So you could write this as SU squared, I suppose, but usually in Hull's book, he writes it like this, just to remind you how we got to that point. And here, by the way, here's an interesting one. Going down and then up, like I said before, is the same as going up and down. So SUD is the same as SDU. And then down here, we simply have SDU. So again, the amount by which we go up or down is a multiple. So this implies that U is greater than 1. Although there are more restrictions than just this. I just want to point that out. But we'll get to those in a bit. And then D is clearly less than 1 because UD is equal to 1. So you could have, for example, let's see, let me make up some numbers. Let's say that U is 1.05. Well, then that means D is clearly 1 over 1.05, which is approximately let's say 95.24. That's fine. Okay, and that never changes. Okay, that is a constant. So SUU simply means we're going up twice. And so that means S has been multiplied by 1.05 squared. Now, SUD and SDU both equal S by definition. And then SDD, of course, is going to be S times D squared. And that brings us down to about, I don't know, let's say about 90.1% of its original value. Okay. So I want to point out too here that the delta T's are always the same, at least in this model. And again, later models actually relax that assumption. So in other words, all the assumptions made by Cox, Ingersoll, I'm sorry, Cox, Rubinstein, and Ross, eventually somebody out there took it and made some tweaks to the assumptions just to see if there's any improvement or not. A lot of researchers took this and ran with it. And so it's like any other situation, you know, you have to ask yourself at some point, is the extra complexity worth it? or were their results so much better that it justified having a lot of horribly complicated assumptions? It depends. It depends on what you're trying to price. Okay, for very basic, plain vanilla options, there's no point in making this any more complicated because it works very well the way it is. But for very complex products, um, you might need the extra complexity. So anyway, so the delta T is a constant, the U and the D are constants. By the way, the U and the D, as we'll get to in a few minutes, is a function of volatility. Okay, so in other words, specifically in their model, this is Cox again, Cox-Russell-Rubenstein, which we will, uh, I guess, what we should do is just continuously refer to it as CRR. So these are some pretty heavyweights of their own in this field of business, of finance. I don't think any of them has won the Nobel Prize yet. I'm not sure what's taking so long. Often the Nobel Prizes are given out as a sort of lifetime achievement award. And so a lot of times the recipients have they're getting up there, let's just say, in years. So it's possible they're just waiting. The Nobel Prizes tend to go through cycles. Like they'll have one year the prize goes to somebody who worked in financial economics, and the next year it might be labor economics, and the next year it might be econometrics or something. So, it goes through this little cycle. One of these days, I think these guys will get it. So anyway, so you can see sigma is the volatility of the stock or the underlying asset. And just to be very clear, the volatility means standard deviation of the continuously compounded returns to the asset. So I want to remind you that in Hull's books, he tends to use continuous compounding in most of his examples, even ones where maybe the others don't. But much of derivatives modeling is based on continuous compounding. So, and you can tell that's the case here because of the fact that E is being used here. That reminds us that this is a continuously compounded process. And so the returns are being measured on a continuously compounded basis. In other words, the returns, there's a couple of ways you can calculate returns. What you're basically doing is you're taking the natural log of the price at time t over the previous price, get to the rate of return RT. Okay, so there's the rate of return at RT, let's say it's today, is the log of the ratio of today's stock price to yesterday's or the previous trading day's stock price. Whereas discrete, the opposite of this is discretely compounded returns. This is the one that most people are more familiar with, I think. You're basically just taking the change in the price of the stock divided by the price that you actually paid for it on the previous trading day or whatever it was worth the previous trading day. Okay, so you've got in the numerator the gain in the price or the loss as a function of the price on the previous trading day. So there's a lot of reasons to use. This is the one that most people are familiar with, but and I mean in the real world, this is how interest rates are typically calculated or rates of return. But there's a lot of good reasons to use continuously compounded returns. There's several mathematical advantages to doing it this way. So Hull is a big believer in this. So you see in his book, he almost always uses continuous compounding. Then you develop a time series of these returns, and then the standard deviation over that time frame is your volatility. Okay, so that word volatility figures prominently in the Black-Scholes model. It's not directly observable, it is implied by market prices, but that's what it really refers to. So the U and the D, it stands to reason, would be based on the volatility. For stock that is very volatile, it would tend to go up and down by more, and there's more of a spread between the branches. Okay, so you can imagine that you've got two stocks. Let's say here's stock A, here's stock B. The one on the left has a very high volatility. One on the right has a very low volatility. So when you model the stock price with the Cox-Russell-Rubinstein model, what you're going to get is something like this on the left. On the right, you might get something like this. Okay, so of course it makes sense. I mean, obviously the stock on the left bounces around quite a bit. So over the time frame, we have to model it as having enormous upward movements and downward movements. Otherwise, it won't replicate the actual volatility of the stock. Okay, so keep in mind the trees are meant to be replicating the statistical properties of the stock that's being modeled. So we're making some assumptions, but still, these the returns themselves are intended to be normal. Okay, now they may have different rates, they may have different means, different standard deviations, but they're all intended to be normal. All right, so let's get back to our discussion about the model. So now, by the way, one more issue that we haven't addressed yet is probabilities. If you look at these graphs, and this is one of the tricky parts about derivatives pricing. What do we do about probabilities? So you probably figure, well, we'll look at market data. And we estimate the probability that the stock goes up or down. No, that is not the case. So rather than using real probabilities, which would be very difficult to estimate in practice because they would take into account people's risk preferences. Now, the risk preferences are kind of an important subject. Just as a quick review, let me just remind us that in economics, okay, we have three types of risk preferences. And there's some branches of economics that focus a lot of their attention on this. There's one area that's getting really hot. It's called behavioral finance, which deals a lot with this. There are three basic types of risk preferences that we assume are possible in the real world would be risk averse, an investor who must be compensated with higher average returns in order to bear risk. So there's a person like this would never buy a corporate bond unless they were promised a higher rate of return than they could get from a treasury bond. Which you think, it's hard to believe anybody doesn't fall into this category. What's interesting is that even here, there are different degrees of risk aversion. Some people are somewhat averse to risk. Some people are really averse to risk. It depends on their circumstances. People who are, let's say, retiring, they do not want to take on a lot of risk. Young people with lots of years of work ahead of them are more likely to take risks. Now, you also have the possibility of being risk neutral. An investor must who is indifferent to risk. Okay. this investor will buy um, two assets with different levels of risk as long as they have the same expected return. In other words, this type of person would buy that corporate bond even if it had the same expected return as a treasury bond because they don't care. Who cares? I don't care about risk. I just want to know what my return will be. And then we have risk seeking, which is the craziest one. This is somebody who actually likes risk, who actually I don't know if I should say enjoys risk, but um, they gain some kind of a benefit. In other words, it's almost like a positive thing to them. An investor who likes taking on risk, this investor would actually accept a lower return from a risky asset than a risky asset than a safe return. Um, sorry, lower return on a risky asset than a safer asset. So in other words, this investor would buy a corporate bond with a lower expected return than a treasury bond, which is completely safe. So, I mean, this is getting into some very theoretical territory. Nobody's ever tried to claim that such people exist, but the reason why this matters is because um, a risk neutral investor, discuss this again, a risk neutral investor will accept the risk-free rate of return, which simply means the return on a safe asset such as a treasury security. From a risky investment. Okay? In other words, the risk in this person will say, listen, I'm willing to buy an Apple bond as long as I get at least the treasury bill rate of return or treasury bond rate of return, I'm happy. So you have to ask yourself, well, why would they do that? But the advantage of this is that if we could assume that people are risk neutral, then we can use only the risk-free rate of interest to discount future cash flows. Okay, so in other words, if we assume that investors are risk averse, then options have to be so pricing options would require estimating the appropriate risky return or the appropriate return, let's say, required by investors to hold risky assets. So that's going to be very difficult to do, okay? Because it's hard to judge. You can't directly observe a person's risk aversion. So in other words, we'd have to use risk adjusted interest rates to discount all the cash flows in our option pricing models. If we assume risk neutrality, then we can use the risk-free rate of interest, which is easy to observe in the marketplace. As the appropriate discount rate for all cash flows. And we'll review this as we go along and go through the model. You'll see that along the trees that we're developing, we have to discount all those cash flows back to the present because they all take place in the future. And the issue would be what rate of interest should be appropriate. So you're probably asking yourself, well, how can we assume risk neutrality? Well, here's the tricky part. It turns out that in this framework, it's actually the Black-Scholes framework, extended to a binomial model. The price of an option is independent of risk preferences. Therefore, the an option pricing model can be based on any assumption about risk preferences. So it is most convenient to use risk neutrality. So as you can prove to the notion of arbitrage, which we discussed in the previous class, and we'll go through it again this time, with the notion of arbitrage. In other words, you can prove that the price of an option has a certain value based on its relationship with the underlying security. And if not, if the price of the market deviates from that price, you could earn an arbitrage profit. Because arbitrage means that you can buy something at a cheap price and sell something at a high price and make money without taking on any risks. So essentially, well, we'll get to this discussion in a bit, but the bottom line is the Black-Scholes model, interestingly enough, is based on the idea that you can take some combination of the underlying stock and treasury securities and create a portfolio whose cash flows exactly match those of the option. So when you price an option, what you're really doing is pricing that portfolio, because if the two deviate, then there'll be arbitrage opportunities. So you'll see that when we derive the risk neutral probabilities in this model, which we will this time, it is based on the idea that any violations of this relationship will be eliminated with arbitrage. Anyway, so it's getting very deep here. We'll get to that in a bit. So what's going to happen is we're going to see that there's a formula for risk neutral probabilities, as they're called, but we're going to show where they came from. Okay, and that involves discussing arbitrage. All right, so in the model that we'll be using, when you look at these diagrams, this P and 1 minus P are the risk neutral probability of going up. Oops. And then, of course, that implies that 1 minus P must be the risk neutral probability of the stock price decreasing. Just clean that up. And so what I'm going to do, and last time we didn't really have time to go through this properly, but we're going to show you where these come from. Okay. So I think you'll find that to be very interesting. By the way, we're not just doing this for the fun of it. It gives us some very important insights into what we're actually doing when we price options. Okay. So those P's, 1P, 1 minus P, are taken from a case where we're looking at what can happen in the future. And so the consequence of doing all this is that all cash flows in the future, their value today is going to be obtained by discounting them at the risk-free rate of interest. Okay. So now, by the way, what the risk-free rate of interest, which we'll designate R, is the yield on a treasury bill with the same maturity as the option. So if it's a 3-month option, for example, then the risk-free rate that we're considering in this model is the 3-month treasury bill yield. Okay. So because that is the rate you can earn, the treasury bill does not expose investors to any risk. So therefore, whatever you're earning from that must be the risk-free rate of interest. So if you have an asset that provides more than that with no risk, then there's going to be an arbitrage opportunity. So anyway, that's our risk-free rate. All future cash flows in the binomial option pricing and the Black-Scholes as well are discounted back to the present using the continuously compounded, usually risk-free rate of interest. Okay. Because of the assumption of risk neutrality. Okay. So in other words, whether that's realistic or not, it doesn't matter because we know that the price is the same whether we have risk neutrality, risk neutral investors, risk seeking investors, or whatever. And by the way, just as far as the terminology goes, if you have something like this, let's say this is a simple timeline. This is today, and this is 1 year in the future. If we're promised a cash flow of X to here, the present value here would be X e to the minus R e. Or actually, I'll tell you what, let's use this notation. Delta t. Okay, so in other words, X e to the minus R delta t is what we call the present value of X. That's how much it's worth to us now. In other words, having X dollars in time one is the same as having X e to the minus R delta t dollars in today. Okay. So you'll see when we go through this and we start pricing our options again, that all the cash flows are discounted in the same way. All right. So now here, oh, by the way, this is one thing that drives me crazy. Some books use the letter K for the strike price of an option. Some use X. Hull's book himself, he at some point switched from X to K. So if you see K in these slides, you know it's the strike price. All right. One day I'm going to have to go through all these slides and change them all to either X or K. But here we're using K. Okay, this is Hull's book. So we're going to use K to represent the strike price. Now in Hull's book, he also used the letter G to represent the real world probability of going up or going down. But we already know that that has no bearing on our ultimate results. So when we go up or down with the 1-period model, remember we said before that the option price, this is a call, by the way, it equals its payoff in the up and the down states. And you notice the difference between the two. It's instead of just saying S minus K, it's SU because we've gone up and SD because we've gone down. And then G is the so-called real world probability of S increasing. You notice how I put in quotes real world. All right, so you have to visualize that it's possible to actually do this. This is the probability of the stock going up over the next interval of time. You can imagine this would be a nightmare to calculate in the real world. And so, it would never, that's why all of this, this whole framework that Black-Scholes put together really made such a big difference in the financial markets. Okay, it's not even just the options themselves, but this notion of risk neutrality and pricing things with it. They really are path breakers here. All right. Anyway, so this must therefore be the real world probability of S decreasing. Okay, again with the quotes. And oh, you know what? As far as the terminology goes, there's one more thing I forgot to mention before. I mentioned the branches and the nodes. You just go back and revisit this. Um, we make a distinction between the nodes at the maturity date. These are called the terminal nodes. And all the earlier ones are called interior nodes. And that's, we have to make a distinction because we know that the behavior of the option is going to be different in the maturity date as in the earlier days. So terminal nodes, as we've already seen for an option, are where we price it based on its payoff. The interior nodes are based on probabilities of going up and down and on the risk-free rate of interest. All right, let's see. So that's what it would look like. That's the diagram for the call tree based on real world probabilities. But as you'll see later on, it doesn't matter what we put here, you'll get the same numbers. Now, this is where it's starting to get very intense. This is what I started to allude to earlier with the Black-Scholes model and this notion of arbitrage. What we're going to do is set up a portfolio, a special portfolio that will enable us to replicate. This portfolio is intended to replicate the cash flows to the call option. And so again, the idea here is that the price of this portfolio has to match the price of the option. Again, otherwise there'd be an arbitrage. We could buy the one that's too cheap and sell the one that's too expensive and make risk-free profits. And in the process, the prices of the two would converge to each other. So because, oh, it's already, I didn't realize it was so late. So I think this is an ideal stopping point because this is a bit intense, but it's awfully important for us to understand what this is all about. Okay, and then this actually is what's going to make it possible to derive the formulas for the risk neutral probabilities. Okay, so all right, I think this is enough for the first session back. And so I'm going to post this, of course, in YouTube and the slides I'll post in Blackboard. And so then we'll just take it from here. So, I'll let you know what's going to happen, the scheduling for this. So I just thought it would be good to get started with a review of the binomial option pricing model, but with more details than last time. And that includes, by the way, the VBA code. So, all right, so we'll stop here and I'll see you next time.